Well, good morning, good evening, good day, everyone. Um, Look, we might start a bit early. So, Jerry unfortunately can't be with us tonight. He's sitting somewhere under the Eiffel Tower having a cappuccino, listening to us all, but he'll definitely be back next week. He said he's looking forward to coming back, and then I know that this will be a regular thing until about November, and I think he's then coming over to Australia. So he's certainly in holiday mode at the moment. But great to be here with everyone. We'll hopefully have a great session tonight. Um, you might have listened to this new podcast that I'm involved with called The Algorithmic Advantage. On that, we had the two quants, Moritz Siebert and Moritz Heiden, on, where they talked about Takahi Capital and their philosophy and process. You guys might have questions. I know that they're going to try and make an appearance tonight. So it gives an opportunity, if you have any further questions regarding that, to ask them about it and get their thoughts. On other matters, Philippe sent me a message on YouTube saying that apparently Andrew Beer mentioned that us trend followers tend to rely on backtesting a lot, and he says that he actually finds that backtesting is not important at all. Perhaps we could discuss that tonight. That might be a good topic to talk about. The other thing I was thinking about was we rarely talk about the systems we use for our trend following processes, and it might be a good discussion point tonight to talk about some of the systems, such as, you might use NinjaTrader, AmiBroker, Excel, TradeStation, multi-charts, trading blocks, or Realtest. There might be things that we can share tonight regarding that. But look, I hope it's going to be a great discussion tonight. Any queries, please don't hesitate to just line up as a speaker, and I'll try and put you on. I'm still sort of getting familiar with this process. But I think we should kick off now with Oleg. And good morning, Oleg.
Hi to everyone. Hi, Richard. Hi, Jerry. Because I know you listen me, and I'm very happy because you are with us. Hi, Jerry. Hi, Richard. Hi, Josh. Hi, Brian. Hi, Alp, and all the guys I see here, as always. I'm very happy to be here, of course. Again, in the wild nature, in very beautiful place, and I have even posted this place in my Twitter profile. Very beautiful place, not far from Sochi. It was very nice week, and I like to be in such places and to think about our trend following programs, about our models, about Harry Moritz. Um, so it's very productive, by the way. I do a lot of research there, a lot of backtest, a lot of different ideas. So I today I started to listen the wonderful podcast Algorithmic Advantage. Only today I've started to do this and doing my notes, and I liked very much quotes from Moritz Siebert, and I did some notes. And I like, for example, Moritz said that from the outside our trend following models can look naive or too simplistic. Uh, and so why would anybody would pay? And anybody can say that why would pay a fee for running these models? But as Moritz Heiden was saying, they're actually not that simple. Maybe these parameter settings and the way that they're set in code isn't all too complex, but you still need the experience and the character to follow these models and to know when the model is good. This is what I think investors are paying us for, and I fully agree with all this because really, and I liked also when Moritz said that it's not a big deal to launch a complex model which looks effective in a backtest. But we must have models that are not fragile. And I fully agree with this, that our models must work in very different environments, and we must have a very big to take as much data as possible. And I know that, for example, it said that some filters they can look good, extremely good, in a of maybe 1, 2, 3 years, but the next year, these filters will make a lot of problems for your trading. It can even make your system less robust, or you can miss a big trade. So we must take the best parameters, and as Jerry says, as much from the backtest as possible. But it must be the main things. The main things, and I think it's of course it's things. It's a structure of the market, the foundation. For example, that as Neil said once, that there is no chart. If we look at a 50-year chart of every market, we will not find any chart without good trending periods. So it's one of the main things. So we must cut our losses and let our winners run. And it's one of the main things. So, and also extremely important things is diversification and risk management. And said before that I have read a book of Peter Thiel. He is a founder of PayPal company. This is a book. It's not a trading book. It's not about trading. It's about startups, about business in general. And he said such a thing that diversification is a. He called it power of law power, because he said that it's better to. Or you could have 100 of equity if you fully fund your own venture, but if it fails, you'll have 100% of nothing, and owning just 0.01 of Google, by contrast, is incredibly valuable. More than 35 million of this when this was written. So the guy from business side said that diversification is the only way, and it's the best approach for your if you want to have good venture capital firm, or maybe a investment portfolio. So I like this when people from the other fields say the same. They apply our trend following principles. And I like this because trend following our principles, as I always say, is very powerful in general, and you can apply it in many fields. So let's get started. I'm very happy to see all of you. Let's get started.
Thanks, Oleg. And look, hi, Moritz. It's good to see you here. Look, just for all of the late entries, I just wanted to say that Jerry's under the Eiffel Tower at the moment, probably listening to this. He won't be able to join us today, but he definitely will be with us next week. But Moritz, it was a great discussion we had. Perhaps you can expand on what Oleg was talking about in relation to the application of these simple but robust models. But also, there was a very interesting thing said by Andrew Beer the other day, which Philippe, a listener, wanted to perhaps consider a debate, where Andrew said that trend followers like to do their back testing and he doesn't think it's important. But I'd be interested to hear your take on that. But over to you, Moritz. Good to see you.
Hi, Richard. Hi, everybody. Thanks for the introduction, the kind introduction, Oleg. Yeah, so these models. I mean, it's didn't who said it? Jerry, was it Richard Dennis who said we could put the rules in the newspaper or the Wall Street Journal and still people wouldn't follow them, even if you made them public. I think to an extent that applies to the way we run these models as well. At least my models, they are not too complex in the way that they are programmed, or the rules and filters. None of that exists. Or filters don't exist. The rules that do exist, but relatively few, right? Because the fewer you have, the more resilient your model is going to be. And the trick, I think, or the challenge is to put yourself in a position where that allows you to follow these systems, which every once in a while, are tough to follow because you have drawdowns and losses, and it's choppy and it's up and down, and these periods can last for a long time, weeks and months, and sometimes even you may not have a good year. And it is that stick-to-itiveness, as they say, that you have, which you gain through experience and trading these markets and these systems for years and years, that you don't lose the trust in this piece of beauty in your model, that you can follow through and see the light at the end of the tunnel. So this is really the most difficult piece, I think, is to have your compass, your personal compass, set straight in the way that you handle this model, and you don't tweak it, don't tinker around with it, don't change it at exactly the wrong point in time. Or you may think it's the right point in time to make the change, but then it will turn out that it's not a good point in time to make the change. And I don't think a lot of people can do this because most people are return chasers. Most investors, allocators, they're impatient rather than patient. They want to have the latest thing, AI stocks or multi-manager pass-through fee model hedge funds, and the latest craze. People are like that. That is human behavior, and I think this is what they, to an extent, not 100%, but to an extent, this is what I think our fee's worth, and why they're paying us, is that we can navigate through that mist, through that fog, and stick to these models, and fate the news and fate the itch. Don't scratch that itch all the time, and fate the incentive or the need to play around with these models and change them. Because I think if we did this, if I changed my model every time I'm in a drawdown, or there's a longer period where just the returns don't come in as expected, I think I wouldn't be making any money, or very little, because these changes will likely be curve fit. They'll be curve fit to that recent experience, and I'll try to find something that would have made the past, say, month or 3 month or 4 month better. But none of that, I think, will have any footing and solid foundation for the future expectancy of the model. So you need to just follow through. You can put the rules. I mean, I'm kind of like, I might at some point just publish the key rules that I'm using on the website. I don't think it matters that much. Most people wouldn't be happy with my model, so they wouldn't be able to stick to it for all too long. And I think that's what the fees for what investors are essentially paying us, and we get, it's a fair compensation for our mindset.
I fully agree, and I remember when Nils said that in February 2018, investors asked Dawn Capital Management what are they going to do to improve their system, because it was a drawdown at that period. And Nils said that the CEO of Dawn Capital answered that nothing, because they don't want to sacrifice all their future performance to have a lot of problems, because only this maybe 1 month. And it's a very important thing to understand. And also I think that I see a lot of evidence of trend following to be working long-term trend following. I mean, classical trend following to be working in the same shape. I think in the same shape as it now. Maybe in 1,000 years, maybe 2,000 years, and I'm sure that if people traded 5,000 years ago, it would also be working if there were trend followers back then. So, a lot of evidence for me to be consistent in this system. A lot of evidence. But I think a person must investigate a lot of different things from different fields, from math, from maybe physics, from maybe statistics, and of course from have a good trading approach, trading theory of our trading. So to understand such things, and so if a person don't know this, it's normal not to all person. It's normal that not all persons, average persons from the world, not understand this. Not all people understand this. So they pay fee for us to navigate, to operate with their money, and to have a profit for all of us. So I think it's fair. I fully agree with this.
Josh, how's it going?
Good morning, Richard, and hello to every guy on the call. Hello. I appreciate you. It's fun to be part of your group. I own it just like you. And when you introduced the call, Richard, I started to scribble notes about things I wanted to talk about. So I've got like 7 fun things here. I think I would just start in this round with the beauty of trend following in 2 dimensions. One, I couldn't trade the other day. So I had to deal with this. I'm like, this is so terrible because I'm a daily trader on the closing numbers. And I put in my orders at night or pre-market. But here I couldn't do it for like a couple of days. And then one of the days in the recent week, I could only take my new trades, but my sells had to wait till midday. And I'm like, this is just wrong. This is just wrong. And then I remembered, no, wait, this trend following beast, this monster, this piece of beauty, as Moritz says, this is an elegant, robust, loose pants, can serve me. And it's fine. It's fine. You know, some of my exits yesterday, these midday exits were lower than I would have had I done it at the opening. But you know what? So what? So what? You know, if I feel bad about this, that's not trend following. That's psychology or human nature or it's not trend following. Trend following is designing and tending to a system that has shown itself to be what's that line from Ben Franklin? Something like, "What have you done?" The woman says, and Ben Franklin says, "So we've given you a republic if you can keep it." And it's something like the worst of. It's like the best of all possible systems. They're all terrible, but it's the best of all the terrible systems. Trend following is the best of all the terrible systems. So that's one dimension I wanted to share. Thanks.
I like it. Yeah, that's great, Josh. Look, there's a couple of others here too, Bruno and Adam, I'd like to introduce to you. But first, Bruno, how are you going?
Hey guys, I'm fine, doing fine. Glad we are all talking this Friday. I must confess I miss Jerry's voice in this space. But as Richard told us, I guess he's laughing on all the absurdities we say every now and then. I would like to chime in this backtest topic we were just talking about. I guess even in that dimension, we trend followers come to that from a different perspective, especially because we are aware that we don't know a lot of things. We don't know a lot of how markets move and how they will move in the future. Because we're cognizant of this fact, we take as little as possible from the backtests. I find comfort in looking at the most generic statistics from my backtests: the hit rate, the win-loss ratio, the sample size mostly, and that's about it. Then I look at the equity curve of the backtest, just to get some intuition if that model or that ensemble of models would blow up. How is my risk set for this for these models and these markets? Would this be too much risk? Too less? Not so much? How is it? But people get a different view from the equity curve. They want to see the correlation, and they want to see how that grows, and how is your CAGR. I think you cannot trust that much the equity curve from the back test. I stick to the simplest statistics: hit rate, win-loss ratio, and sample size. Thanks.
Yes, no, I agree, Bruno. It's interesting. Like, I didn't actually hear Andrew Beer say that directly, but I did hear it from second sources that he said that he wonders why we take so much information from the back test. And as you said, I don't think we do. And but interestingly, from a replicator's point of view, they are replicating. He is replicating the SocGen CTA index and the managers within that. He's replicating their positions. So he's sort of like using their back tests effectively, because they probably all do undertake back tests in the development of their models, but his replication process is basically works off the result of their performance. So it's a strange comment from Andrew, and hopefully Jerry might be able to get him on to explain himself. But it was an interesting comment. But look, I'd like to introduce you to my boss, Adam, from East Coast Capital Management. How are you, Adam? Good to see you here.
Oh, hi, Richard, and thank you very much for that invitation. And hi, everybody. It's great to finally chat with you all. I'd like to just, I guess first say, Richard and I had a great time in KL a couple of weeks ago. We did a little bit of a marketing tour, and, beautiful city, and we certainly enjoyed our view from up the towers, the Petronas Towers, and dinner and drinks on our last night in KL. Back to business, I think, just like Maritz said, and, much like the original Turtles and their simple rules, at East Coast Capital Management, we like to keep things simple. And, we obviously have an algorithm, and, for everybody's education, whether you're doing this professionally or, in the retail space, of course, there's an entry, there's an exit, there's a position sizing element, and then a trailing stop to control risk. And then we apply those rules religiously over a portfolio of futures. And, that's what gets us into markets like right now, orange juice, live cattle, sugar. And these charts are going fantastic. And, we'd like to take all the credit for the profits and losses that are coming in, but it's really those markets that are doing the hard work. And who's to know what's going to happen next? There's a lot swirling around in the markets at the moment, whether it's the oil price or, some disturbing things coming out in different regional centres and areas. But one thing is if you're doing trend following properly, you are going to be on that next big trade. And so guys and girls, I would say just try to keep things simple. Take that next buy or sell signal, no matter what is on the TV at that moment in time. And look, thanks for listening, and back to you, Richard. Thank you.
Thanks, Adam. So, look, if anyone's got anything explicit they want to talk about, I'd like to perhaps start off with talking about the systems we use for trend following. So, does anyone want to sort of ask any questions regarding the type of systems that can be used for trend following within futures or in other liquid markets? We brought up things like Trading Blocks, AmiBroker, TradeStation, NinjaTrader, all of these things. We had an interesting discussion with Marston Parker the other day. He's developed this real test software, which is obviously another good product. But is there anything people want to bring up here?
Oh, Richard, is that directed at me?
Directed at everyone. Adam?
Oh well, look, I do run with the AmiBroker software, and I think it's fantastic. And and then we do a little bit of stuff in Python, and just try to use whatever tool is best for the job. But I'm actually open to all sort of ideas and technologies, whatever sort of gets the data flowing and the creativity with the parameters.
And Moritz, you mentioned a very interesting thing on the podcast, how you started in the Excel environment. Do you want to go back to those old days and explain what you did there, and how you used Excel for your trading models?
Yes, and I'm not blushing. I still use Excel. I mean, not in an operative environment for our trading. This is Python based. It's in a cloud based environment. For quick testing purposes, we sometimes use blogs. The other day, I downloaded the Marston Parker system just out of interest because I wasn't aware of it. I like playing around with these things, just seeing what's out there. I haven't worked with it yet, but look, I mean, Excel it has become so powerful in 64-bit with these powerful computers these days that it is absolutely no problem to run a trend following system out of Excel. I know sometimes it's frowned upon when you mention that, or if you say you're raising money from an institutional client and you would tell them, oh, I'm running this out of Excel, they'd probably kick you out of the door. Say like, why would you do this? This sounds so old school, and it is you're not responsible. And well, I don't know. It is Excel is great for a lot of things. It is you see what you get. You can work with it. It's essentially the software that I was brought up with for the past 20 years. It is my favorite toy in a way when I work with a computer. So I have nothing bad to say about Excel at all. I think it is fantastic for some early testing, getting your head around things, testing things out. It's just great. Now, it's probably not the best thing to run in a production environment because, different people can access that spreadsheet and make changes, and you don't have any really record of that. And it is, with Python these days, it is just so much better to create a very robust operating environment. So that's what we do, but I have nothing bad to say about Excel at all. I want to make one final point on what was just mentioned 5 minutes ago on the, I think by you, Josh, on the not being able to trade and maybe trading a day later or not getting into a market and things like that. It is really that, by the way, I think is another psychological thing in a way that requires some training and experience when you have these slippage experiences, which we all have. For instance, the other day, I think I got a short signal on lumber, the new lumber contract. It's the first time I trade this new lumber contract. They've changed it on the exchange, and so I got in with a partial fill. A very small fraction of the target lots that I wanted to sell got filled at a very nice price, better than essentially the target price of my system. But then the market moved fast, and I didn't get the other lots filled. So the thing is, I decided to go to the market and get that position. I didn't want to be too picky about $2 slippage on a contract that, when that trade goes my direction, the $2 or the 2 points slippage on the entry, they're going to fade into the background relative to the P&L that I could make with that position. That really, you immediately change your frame of mind and say, don't worry about these two points of slippage. The next time you do a trade, maybe in lumber, maybe in another market, that slippage could be exactly the other way. But the risk of not having that position on is far greater than the cost of that bit of slippage. So really, that's another thing, right? I've heard a lot of times from other traders that they would be essentially too greedy on the entry, looking to get filled on a better than system price on an aggressive limit order, and then they don't get the fill, and it kind of hurts them because they wanted to, outperform the market essentially, and they end up with no position or only a very small position, and that again is something that you just need to put into your head is when the system tells you to get long or short, that is what you do. You may do it a day later, you may do it maybe 2 days later, but regardless of where that price is, somewhere around there, you have to open that position to get it. Because not having that position on, that could really be the thing that is, you'll regret this at the end of the year potentially, because you may have missed orange juice, you may have missed cocoa, and that means you'll have a very different experience and a very different P&L. So just make sure you get into these trades, and don't worry too much about a point or two here and there. You'll make it back somewhere else.
I agree, Moritz. Interestingly, I've done a bit of studies on what happens if, we significantly increase a spread 3 or 4 times, or we delay our entry by an hour, 2 hours, 3 hours. I've done that research because in my platform that I work off, we can sort of run those tests, and what I conclude is that the outliers that are driving the P&Ls of our returns are such high magnitude events that this small scale stuff we're talking about here, the precision of entry, all of these things is really immaterial in the scheme of things. And I find that, provided we're not too late into entry, we can afford to miss the occasional one, maybe one day, and come in the next day, etc. As you say, the material impact on the P&L is marginal, to say the least. So totally agree with that. Bruno, so Brian, you're here. How are you?
Oh, I'm good. It's happy to be back and having my morning coffee to go along with Jerry's mocha or cappuccino or espresso or whatever they drink underneath the Eiffel Tower. So I'm happy to be here, and I am as someone.
It'd be Veuve Clicquot, wouldn't it?
Yeah. And I am interested more in coming from an ag background, and that being, marketing for our grain operation, where we have traded spreads on a momentum basis historically. I'm really fascinated and interested in what Moritz is doing on that front, because I think that I always kind of cringe when I see him pop into my algorithm, because I'm kind of like, don't let the cat out of the bag, because it is something that does work and is easily adaptable. So that's what I'm curious about.
Enlighten us, Moritz.
Yeah. Well, great to hear, by the way, Brian, that you also found that trading momentum or capturing momentum and trends in these calendar spreads works. As I said on the conversation with Simon and Richard, I initially wanted to, and maybe I still hiddenly want to, but initially I started out with cross-market spreads, crack and crush, but also, the synthetic market spreads where you combine all sorts of assets, gold and cocoa or whatever, right? You just create these spread markets because you can take differences between prices, you can take ratios and see what happens there. And I was so intrigued by that. I said this before, is because I heard a lot of other CTAs speak about this, and maybe they do this, maybe they don't. Maybe they exaggerate a little bit. I really don't know, but maybe they don't. But they say, look, we're trading all these synthetic markets and spreads, so I thought I should give this a go. And as far as these cross-market and exotic spreads are concerned, that was just something that that's just me, I couldn't get to work, at least not to an extent where I'd be happy with the way it looked. I thought it was very left-tailed. It just didn't have the kind of like trend-following characteristic that I like. And it had all sorts of complexities, which I found difficult to really cope with. I mean, different currencies is one thing. Like if you do gold versus milling wheat, you have a euro US dollar position. You may not necessarily have to care about this, but it's something that was in my head. It's kind of like, do I want to FX adjust this or not? What does that then do to your position sizing? Do you take that into account or not? Then you have different role dynamics depending on the contracts that you're looking at. One contract may roll way earlier than another. So one leg of your spread all of a sudden moves in time to a different point of the term structure. And I think that stuff is probably a key driver why it didn't work for me, because you all of a sudden have a jump in time. You're moving one contract to a different point on the term structure, whereas the other leg of the spread may not move, or it maybe if it does move, it moves to yet another point on the term structure, because these markets, they don't have the same expiration schedule. They're not all on the monthly schedule or something like that. Sometimes the contracts are spread 3, 4, 5 months apart. So it is. I tried. Maybe I'll try again at some point and come up with some new ideas. Put initial stops in there. I wanted to keep the risk under control and then just run with the position, essentially allowing the winning trades to take care of themselves and go for as long as they can. But I couldn't get to a point where I was satisfied with that, and that is also because of the fact that if these spreads, they have a clock ticking on them, they have a natural, like a time stop. That you would probably understand. Time stop just means that at some point you will close the position no matter what, only because time has passed. You might say after 20 days in the trade, I'm closing the position. That is a time stop. These spreads, they have, I think, an inherent time stop because one leg of the spread will approach first notice or expiration. And at that point in time, when that happens, you have to act. You have to either roll that leg or both legs of the spread. But if you do that, you're really moving into a new spread, which not necessarily, well, let me take that back, which for sure isn't identical to the one that you just had on, because it now lives in a different time space. It lives at a different point. It sits at a different point of the term structure in the future, and it will therefore have different behavior, different funding dynamics, seasonalities. All these things come into play, crop cycles. So it is this kind of like interference, or this background setting that I believe, without having the proof, is one of the reasons why I couldn't get it to work to my satisfaction. Maybe to somebody else's satisfaction. It didn't look horrible in the sense that it produced trade statistics that were like, oh, it's just yuck, or like an equity curve that's just moving south. But it just it was too left tail for my liking sometimes. And when I looked at the single market system, that looked way better, and it was also cheaper to trade, and less frequently I needed to trade because I have longer average hold periods on the single market system because they don't have the time stop, and less commission and less spread because I only need to trade one leg as opposed to two. So there is a kind of like a higher hurdle that, in all fairness, I need to put onto the spread system to get it into portfolio. It needs to jump a little higher to make it, given that it's kind of like the way it's set up with two trades, and the rollovers are more expensive because you're always rolling two legs, stuff like that. So I couldn't get that to work. Sorry for the long introduction, and went back to the calendar spreads in commodities because that is where I had experience from my days at a Quantum, where we traded essentially in a combination of things such as providing liquidity to large index rollers and fund flows, swap dealing flows that had the GSCI index or the Dow Jones AIG back then, now Dow Jones UBS index as an underlier. And as you know, they have index methodology documents which are available publicly, so you can read them, and you will exactly know when these indices will roll their positions and in what markets. And there's also information available on their size, so you can anticipate how many contracts they will roll. This was a nice trade, a very consistent superior return that could be achieved, or alpha that could be achieved by providing liquidity or front running these roll periods. And it has decayed, in my opinion, because the indices have changed. Clearly, those funds and the people that were running this business, they now know that there is another side to that trade. You know, so like some of these arbitrageurs called it, oh, we're picking off the dumb money. Obviously, when somebody tells you that, you don't like that, and you feel inclined to change. And they did change to constant maturity indices and commodity indices that distribute their positions across the curve. So you can no longer just point to 5 business days in the month and kind of like arbitrage that flow that comes in. It still exists a little bit, but I don't think the expected returns are anywhere near as attractive as they once were, and therefore that strategy is something that I wouldn't be trading today. But we did back then, and not only did we trade that, we also hedged some of our risk by, having a position like an opposite position post the roll that we would hold that very close into the first notice or tender period, essentially then dealing with script traders. So you have oftentimes traders which are a little bit caught up by the fact that markets are now inside their first notice window, or the notice window, where the delivery window essentially, and they forgot to roll or trade out of the position. And this can be an attractive trading environment too, but it's very volatile at that very, very short end of the curve, where essentially you move into flat price and then physics take over. You make delivery, or you take delivery, there's no longer any ifs or buts about what the price is going to be. There's no forecast on funding or any of that, right? It's just that's the price of the spot commodity, period. So that's what we did, but a lot of that stuff has gone away. And so I looked back into these calendar spreads and thought, well, why don't I just try to do the trend following thing, which I love, on these spreads and see what I can find. And that's what I did. So I'm looking at really hundreds and hundreds of spread combinations, but they're now all intra-market. They're no longer cross-market. And I'm looking to be long spreads that have the best trends to the upside, and I'd like to be short spreads that have strong trends to the downside. And you won't be surprised to hear me say that this is done with defined risk and appropriate position sizing, essentially in the same way that I would run the single market system. That is it. I need to be a little bit more careful with sizing, because we're now sizing a spread, and you essentially have two things that can move, and spreads, by the way, can become extremely volatile. So they can be very tailed, both to the left and to the right. And I'd rather want to be cautious and not overdo it and get thrown into the mixer when one of these spreads blows out and I maybe have the wrong position on. So what I want to say is that only because there are spreads, and usually they behave, and you kind of like you have this lower volatility experience, these things can be nasty at points and really rock your portfolio. So you want to be careful there. And so let me stop here. I'm talking for a long time, but in essence, this is what I'm doing.
Thanks, Moritz. Look, I see Bruno wants to say something, but before I get Bruno on, hi, Pete. How are you?
Hey, good morning, everybody. How's everybody doing?
All good.
Good. Thanks for asking me up. And I know we talked a lot about methodology and implementation. I might switch gears here just briefly. and ask about sort of the business model of some of the firms that are represented here, yourself, Adam, Ritz, and others. When you're presenting this to investors, how deep do you go into your methodology, and where do you find the difficulties in sort of explaining your methodology, how you react to markets, and all that to raise money, raise new money for your AUM?
Adam, go ahead.
Well, we try to be as transparent as possible, without giving away the secret sauce. So I know that's sort of a slightly contradictory answer, but you've got to hold something back because otherwise you're giving away the keys to the castle. But my preference would be to be as transparent as possible and give as much information, as is reasonably expected for someone to make an informed decision. Thanks for the question.
Moritz.
Yeah, I think I'm probably 90% glass box to people that would ask me. I don't see any reason why not. I don't necessarily tell them, as Adam was saying, like the nth detail, like, what exactly is the length of my look back window for my trend following program. I don't think that is really that. By the way, that also shouldn't be all too relevant for a client to ask. All right, I'm telling them it's long term. It's a long term look back window. It works on daily bars, whether that is X days or Y days. It's somewhere there out in the long term space. And so I keep that confidential. I would disclose that to my friends and people in my close network, and so essentially there I'm a glass box. I don't keep that much back. I don't necessarily tell them what my initial stop is, like how many ATRs that is away, but in terms of like how the system works and that I have one entry, one exit, one stop loss, that is a breakout based system. I mean, come on, you're 90% of the way there. I'm 100% transparent about the markets which I trade. I share a spreadsheet with all the markets included on our investor portal. If somebody used an AI or just normal thinking, Andrew Beer would definitely be able to replicate me without any regression model. You can just listen to me.
Never.
and copy me essentially, but and he will probably get to a good correlation. But again, most people don't do that, and they would find it very difficult to like the model which I like. It is my model, not yours. I know Richard, Adam, Jerry, you could work with my model and you would probably like it. But you have your own, which is very similar to mine, and you love that one. And so we all have.
Feel free to send us your model, Moritz. No problem.
Yeah, but
and doesn't this sound a lot actually like the original Turtle story, where they put a whole lot of guys and girls in a room and give them all the same information and the same rules in the same markets, and then they all go out and some of them have really wildly different results. So like, what's up with that?
Exactly. So there you go, right? So same, you give 10 people or 20 people or 50 people the exact same model. You will have, if it's 50 people, you'll likely have 50 slightly different results and some really outlier results, right? In both ways. If you purchase any of the software packages that were mentioned earlier in the call, then they come pre-configured with some really good trend following models. They're already there. You don't even have to program them. You can just change a few parameters and you have it. The thing is, again, if you haven't traded for, I think, a longer period of time in your life, and if you haven't taken losses, many losses, small losses, then you will probably find it very difficult to work with these models, because there's always something out there on TV or always something on Twitter or LinkedIn where somebody tells you that they have found something that is just way better. It's the latest thing that now works. 0 DTE options, sell them, right? Or do something in crypto, or do them. I don't know. This is just life. There's always something, and then people migrate to that, and they give up on that model, and maybe they never come back, or they fail to work with these models for a long enough period in time. They become impatient, and then they think it's a bad model, it's rubbish, it's not working, it's just how can these trend followers actually stay in business? Maybe this is one of the reasons why we stay in business, is because so many people are put off by that thing, and they think it's inferior, and therefore it's a less crowded space. I don't know. But yes, to sum it up, I'm fairly transparent about what it is that I do, and don't necessarily mind it.
That's awesome. And I'll just a follow up. When does anybody care to share their methodology of sort of implementing new money? Do you have is it all in from day one when you're allocated new money, or do you have sort of a tranche schedule, or is there any methodology that you found work better over the years that you've been running your models when you're deploying new money?
If you're asking me, I can just give you a very quick answer. I deploy that money. My aim is to track my model, or the theoretical performance, let's say, of that model. And if I didn't deploy the money, if I didn't put on the risk, then the portfolio would deviate from the model. So because I cannot forecast whether it's better to deploy a portion of the money today and another piece of it tomorrow, or just smooth it out over a week, or only take trades in or favor opening trades in, say, markets which are already relatively close to their exit or to their stop, because you might say, okay, here the downside is even less than the initial risk I want, and you're not putting as much money into the markets which have a lot of open trade equity. I don't think that is good trading behavior, because you would then say, okay, I'm not going to put that much money into OJ and cocoa and sugar and these markets and the bonds and these markets which have made a lot of money for us in recent weeks. But essentially what you're doing there is you're implicitly and hiddenly making a forecast on the future performance of these markets, and that is exactly the stuff that we don't want to do. That is what we do not do, because we're very, very bad at making forecasts about anything. In fact, I'm not good at that, and I don't think anybody is good at that. Forecasting financial market prices is something that people in the media and journalists and the clickbait people on CNBC do, because that's their business, but they usually fail. All the investment bank analysts this year have now apologized, essentially, because they've said at the beginning of the year that the S&P would go down. How can the S&P be up with the Fed having rates at 5.5%, the short rate, the SOFR rate being at 5.5%, and yet here we are, the thing is up 15, 16%. So usually they get it wrong more often than not. And I'm part of this pack. I couldn't forecast, and I don't want to give you any forecast for anything, because these markets move wherever they want to move, up or down. And the same is true for orange juice. Whether that sits on massive open trade equity is of no consequence. It can go way, way higher, and it can immediately go down and hit my exit. But for me, that is a coin flip. Personally, as a human being, I cannot give you a logical or intelligent answer or reason as to why either should happen and the other shouldn't. So therefore, I take the position, and by taking the position and implementing the money, I trade the model. And this is the aim. This is the goal, and the objective is to trade the model. This is what I want to do. And therefore, the money needs to go in. And if I didn't put the money in, I would deviate from the model, and that's not what I do.
In my opinion, if you're going to allocate money, I think you should put all of the trades that are currently on in the system on, and not cherry pick. So, if you got an investment and you had a portfolio, and let's say that it had 60 futures, and let's just say that the live positions was 20 current positions, you should implement all of those 20, regardless of whether they're performing really, really well, or an individual positions are in a drawdown. And I think that's the way to go when taking in money. And then I think there is, an approach to, I don't really know, sort of timing the equity curve. I think, is a phrase that I've heard mentioned. And, I just think markets are unpredictable. So I don't think that you can necessarily predict the future. I think trend following has a positive expectancy based on the data that we've looked at, and that's why we're all doing it, because we expect to make money. But I think, timing that equity curve is a tricky business, and you should be wary of being effectively underweight, like Moritz has alluded to.
Yeah, no problem.
Bruno, how are you?
No problem at all. The discussion was really good. Actually, I almost forgot what I was going to ask, but I got it. I got it on my notes here. So back to that spreads, trend following with spreads. First thing is, Moritz mentioned that they have a time stop. So it got me thinking on two fronts here. First, are all of our models equally suitable to these spreads? Because if it has a time stop, perhaps I don't know how this prices behave. So I'm just wondering here, but I got the notion that it may behave similarly to those VIX futures, or those things that happen really fast and then get back to a normal level equally fast. So once I tried to apply a trend following system to that VIX futures, just to see what I was going to get, just to see how that behaves, etc. And it doesn't do very well. And a couple of interviews I listened from those vol traders that they don't have it fully systematic. Most of them get the dilemma for them is when to exit the trade. They cannot fully trust their systems on that front. So it got me thinking if with the spreads would be something similar. Moritz kind of answered that already, but I'm asking anyway. And I wonder if shorter term systems wouldn't get that behavior. And the second question is, do you trade each spread as an independent market? I mean, take for example the July-November soybean spread. So July-November for 2023 is one market that's independent from July-November 2024, etc. Or would you pad them as a continuous future, as we do with everything else?
I look at the single markets or the single expiries. So with the spread system, there's no rolling taking place. I'm not feeding that system pre-rolled time series, but really only the individual series. So there's no adjusting, none of that going on. And then I think one of your question was maybe how do I trade them? Some spreads, many spreads are listed on the exchange, and you can trade in the spread market. And some spreads even have a TAS market. The question is whether you want to use that market. So TAS means trade at settlement. It is essentially an order function or an order type that allows you to exactly realize today's settlement price. It exists, by the way, for outright markets as well, and is more liquid even there, but it also exists for some spread markets, not all, only for some. So if you really wanted to make sure that you get done at the settlement price for that day, you could engage with these TAS markets during the day, and maybe you would have to pay up a tick, or maybe sometimes you can trade exactly at zero and get today's settlement price. I actually rarely use them. So yeah, you can trade the spread markets, but sometimes I get into a combination where the spread market doesn't exist, or where even if it exists, it is not liquid. So for instance, there is a Kansas wheat spread that the other day I was looking at. I think it is December this year versus May of 2025. So this is a very long dated spread. This is not a like near term spread. And so that spread market exists. December 23 versus May of 2025 is listed, but nobody's there. So you can put an order into the order book there. It will just sit there, and maybe Ken Griffin at Citadel at some point will meet and greet you in the order book. But odds are that just nothing will happen. You're the only participant. So if you really want to get into that spread, you would have to trade the single legs. Obviously, December 23 is liquid. May of 25 isn't as liquid, but as a single market, there is some liquidity there, so you do get done. And this is interesting, right? Because you would think that all of the electronic trading eyes out there would kind of like price all of this at arbitrage, and that they would also work in the spread order books. But this is not true. This is interesting about these markets. We always think, oh, everything is so efficient and super liquid, and well, it's not always the case. Like I say, in some of the far dated expirations or medium term even expiries in some markets, not crude oil, but Kansas wheat is a good example. It's a manual work involved. You want to have a look at the order book. Want to have a look at the historical volume, see when that volume comes in. If it's the old like floor session, the old pit session, when the liquidity concentrates, or whether like the liquidity is essentially distributed over the electronic session. Stuff like that is what I do. And therefore, that's also one of the reasons why I enter orders manually and don't have them automated for execution, because, I don't want to be just putting orders into the market into order books which have no liquidity, and then you pay massive bid offer spreads and stuff like that. So I don't do that. Thank you.
Yeah, all great. Thank you.
Jay, you've been waiting patiently. How are you?
Been a long time, but I'm happy to be back.
Anything you want to bring up in this conversation?
At this moment, my thoughts have been more around how do I know when my strategy works, and I think this is a topic that we've had multiple times, anyways. But sometimes like you can do backtesting, of course, and it gives you information so far. But I've been more looking into like actual live testing, so actually doing the work. But then as well, the question is, how long do you keep the testing for until you're certain that the results that you see is the actual results that you get in real time? Even though you do forward testing, so you do it in real time, but still, is it a month? Is it 2 months, 3 months, 6 months? So that's been just something that's been going through my mind, really. I don't know if anyone has an idea on that.
Yes, Jay, I've come across that, and I've got a sad story to tell you. So when I first started out this venture into trend following, it was different to other models like mean reversion, pattern recognition, those things, because when you apply mean reversion, pattern recognition, etc., the assumption is that you're trading those patterns right up to the out of sample component, and then you assume that those patterns extend immediately into the future. So your out of sample should basically adopt a similar trajectory in equity as your in sample component. But that's different to trend following. And what I found with trend following is that because we don't know where and when these outliers will strike, inevitably, as soon as you go into an out of sample component, you can be waiting months. And when you first start out a trend following portfolio, if you imagine our models are medium to long term. Now, what that means is that in the initial 3 to 6 months, most of the trade activity that occurs are actually losses during that period of time, because none of the outliers sort of get traction until, a considerable period of time. When we're trading medium to long term, over the course of a very long sample set of our trade history, we might have an average hold of, say, 10 to 12 months with a maximum hold of, say, 4 years. So when you start out with your trend following portfolio, particularly during, if for instance you started out during that awful decade we had after the GFC, you might be waiting a few years before you get any traction in your portfolio. That's what I was finding. When Jerry started in the 1980s, trends abounded everywhere, and I don't think he suffered that symptom. But, when, for instance, Mike Melissino started up, I think he did suffer that early symptom before he started getting traction. When Purple Valley Capital started, they had a long period of time before they got traction with their outliers. And I found in my research that it took up to 6 months before I started getting traction. So I had to absorb the punishment for 6 months of lots of small losses and a building drawdown. Unfortunately, I personally don't think there is a time we turn off our models. If we've done our backtesting process and our research correctly, over very extended data sets, multi-market testing, all of these things to make sure that our models can capture outliers when they are present and they minimize losses during unfavorable regimes. I think that's the best we can get. So I don't think there is a point that we turn off our models personally. I think this is unlike other methods where if the edge isn't immediately exploited and you fall off the cliff straight away with negative skew, that's when you do need to turn off your models. But I think in our game of trend following, we've got to be much more patient and just accept the fact that in the early implementation of our portfolios, there's inevitably a period of time before the portfolio gets traction. I'd be interested to hear what others have to say on this. Does anyone want to bring up any points?
I think that I like your idea, Richard, and I want to say that I think, first of all, we must have as much backtest as possible, and of course, maybe now, first of all, understanding logic of your system, philosophy of your system, and after that, you must have as much backtest as possible to prove maybe one another. And so I think only so I always remember when Jerry said that look at the weekly charts and you will see, if you're a long-term trend follower, you will see how wonderful trends occurs, how much the trends you will see in the markets. For example, it's my examples. So I mean that backtest, experience, and of course logic behind the system, philosophy behind the system. And if you have this, it's much easier. Here's my point.
We've got some new speakers lined up here. G'day D, how are you?
Hey, what's going on, guys?
All good down here in sunny Australia, that's for sure.
So good morning. I wanted to ask a question. I don't think it's totally off topic, but it might be a little off topic. I know that you guys, mainly follow price, and I totally understand that, and it absolutely makes sense. And I actually watched a video that you suggested, Richard, about Bill Dreiss, and he was talking about systematic trading, and back through the 80s and the 90s. And a lot of the edge just came down to the risk management that you get from, being a systems trader. And almost that in and of itself was a good portion of the edge. And it makes sense because risk control is, that's everything. But I just wanted to ask you, I think it was probably about 6 months ago, 8 months ago, I was watching a video on Top Traders Unplugged. And I can't remember who exactly it was, but the gentleman was talking about commodities, and he was saying that very seldom do commodities stay in a sustained downtrend for say like 3 or 4 years. And he gave the exact data. He said there were like five examples, or maybe 4 examples in the past 40 years where a particular commodity was in a downtrend, say for 4 years. Do you guys use any price data like that when just kind of analyzing the trends?
Look, I personally view commodities like any other liquid market. So when I undertake my workflow process over commodities, my assumptions are the same as if I'm applying it over fixed income or currencies, or I'm trading equity indices. So, but I do know that we do get sustained periods of commodity downturns. Crude oil was a great example back in, I think, March 2020. That was a classic downtrend where it went through zero, if you can remember, I think down to minus $40 a barrel. Yeah, no, it was interesting. I wish I could remember who that was who mentioned that on Top Traders. But
do you recall the episode that I'm talking about?
Look, vaguely in the back of my mind, I can. I just can't put my name on the person who was mentioning it. Interestingly, you were talking about Bill Dryce, and with this book I've been reading, which is Tim Palmer's book called The Primacy of Doubt, where he starts looking at the fractal nature of these complex systems. I just wish Bill was around these days as an active fund manager, because I'd like to get into his ear and say, has he read the book? What does he think about the fractal nature of the markets? Because I know that he deployed that with his systems, with his fractal wave algorithm. Bill had a magnificent track record for so many years, the Dryce Research Corporation, and I know Moritz is all over this, but Moritz certainly is very interested in Bill Dryce. So, Moritz, have you got anything to say about Bill?
Yes, only positive things. I think Bill is one of the great trend following traders. He unfortunately shut down Dryce Research Corporation about maybe a year and a half ago. I used to run his trading desk for quite some time. Not sure if you knew that, but I was essentially working with him, and I therefore know the system that he trades. What I can disclose, and that probably isn't a secret, I mean, Bill is trading off, or was trading off, weekly bars, not even daily bars, weekly bars. And therefore, the system was run on a Saturday or Sunday with data from CSI, processing weekly bars, put into the fractal wave algorithm. He was essentially looking for zigzag sequences, so higher highs, lower lows, things like that, but in a certain zigzaggy type of fractal fashion. But then it wasn't all too dissimilar from what it is that we've been talking about on this podcast with respect to like initial stops and then trailing exits. So it was in terms of running the daily business, if you will, there wasn't really a daily business, because it's again, weekly bars. Most of the work was done on a weekend, which I think favored his lifestyle of he lived in Western Australia for surfing, and then in Hawaii, big surf fan, so he had time during the day. He had stop orders in the market with brokers, and that just wasn't really anything to do. But his mindset and the way he trades, cope with the system, is 100% trend following. He completely got that. It's just a great guy, good trader, very disciplined trader. So yeah, I have only positive things to say about Bill.
FX Barber, how are you?
Yes, thank you so much for taking my call, Richard. I appreciate everything you guys do on this platform. I've been listening to you all for the past year, and it's just so amazing. So thank you. I'd like to follow up on this question that I believe Jay asked on his process. And my question is more as far as how to deal with this particular periods at the beginning that can be very painful, because they can take a long time for these trends to mature, which is understandable. I believe there has to be a limit as to how many positions you're willing to open, even if you're using small bets in order to limit your drawdown, not your your drawdown or your maximum loss to a minimum. Let's say you have a capital of 100,000 and you want to always be exposed to a maximum risk of $30,000, right? You want to limit a certain amount of trades that you open, or I would imagine that you want to limit a certain amount of positions before trends can mature. Once the trends do lift the account balance, then maybe at that point you can re-enter more positions. But if during the first initial period of 6 months or a year where you're building your system and your positions are, and your system is taking positions, and those positions get closed because there are losses, perhaps you shouldn't keep entering more positions. It's it's tricky, right? Because you don't want to miss on the potential trades that could end up in potential good trends, but at the same time, you cannot keep on taking more trades without seeing the account take a lift. Do you see where I'm at with it?
No, I see what you mean, but the problem we have is that when we are constructing our portfolios, we're basically putting together, say, 70 markets. There might be numerous systems in each of those markets. We're putting them together as a portfolio, and when we've undertaken our back test, we've undertaken a back test of our models on each of those markets. So if you could imagine, the rules that have been baked into our portfolio is based on the assumption that we take every trade that's in that rules-based process. Now, when we put that into a portfolio and we look at the portfolio heat at any particular time, we start getting worried that we've got too much risk in our portfolio. Now, I used to think that way, and I used to think, well, maybe I should be not putting on additional trades, etc., with that heat. However, I've had to deconstruct that logic because the logic I applied in my back test never had that heat, that portfolio heat at any particular time embedded in its rules-based process. So what I had to do was that in developing my back test and then in developing my portfolio, I basically rigorously undertook this process over, say, a 30-year time horizon across, 70 markets or so, and that produced a portfolio equity curve. We had, all of these different individual return streams for the different markets, and then how they all consolidated into a portfolio gave an overall drawdown for that portfolio for that 30-year period. And then what I said to myself was, well, recognizing that your drawdown is always going to be worse in the future, I just conservatively said, well, let's assume then that my drawdown is going to be twice as large as the drawdown I've experienced in my back test over 30 years. Then what I've done is I've said to myself, right, recognizing that possibly the worst case drawdown might be, say, 40, 50%, 60% or whatever, then what I do is I say, right, now let's determine an allocation on that portfolio using my realized balance, and I might have come down to, say, 0.5% of my realized balance for any individual trade to produce that worst case scenario. So effectively what I'm doing is I'm not looking at the portfolio heat at any particular point in time with the assumption that, well, under a worst case scenario, everything could go down to my trailing stop immediately. That's not the way really our portfolios work, because we're long and short in our portfolio. Our systems are diversified systems with unique entries and exits if we're applying multiple systems. And even though theoretically it looks as though the worst case scenario could be extreme, it never actually is that extreme, because there are sufficient, correlation offsets in your portfolio and sufficient covariant sort of offsets in your portfolio that would actually never occur. So the way I decide what level of risk I'd apply to that portfolio was based on this very large back test, very conservative estimates, something I was happy with, something I could sleep at night with, and I just let it run there. And I just had to do that because if I looked at portfolio heat and said, oh, gee, there's too much risk in that portfolio if things go wrong, the first thing we've got to recognise is, well, a portfolio is a risk sponge and it naturally carries much more risk than what the individual return streams in it have, because it's a summation of all of the